This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices a little bit lower this morning. We did have Janet Yellen's testimony before the Senate Banking Committee starting at 9 o'clock Central Time. The initial testimony was viewed as neutral, maybe just slightly bearish on balance, and we did see a little pressure in stock indices. However, I think her testimony overall is going to be very balanced. We continue to believe that the Fed will not be in a position to raise interest rates anytime soon. Also, the Fed chair commented that some risks to the U.S. economy could pose from the overseas economies, which are weaker in various regions. So overall, a rather balanced testimony with what we're seeing so far. Longer term, still thinking stock index futures will continue to advance. Over in the currencies, the dollar index was higher in the overnight trade on ideas that Yellen's testimony could be a bit hawkish on balance. Since then, we have seen the dollar index coming off of its highs. This after the consumer confidence report here in the U.S. coming in a bit weaker than expected. Also, we are seeing a little pressure in the Japanese yen, even though various Bank of Japan officials have in recent days indicated that there may not be a need for additional Bank of Japan stimulus. Our feeling is that that will not be the case, that they will need to add more stimulus down the road. So the yen will probably continue to work lower longer term. And in the interest rate markets, pressure developing earlier in the session on ideas that Yellen's testimony could be a bit hawkish, which would be bearish for the interest rate markets. Since then, though, we have seen somewhat of a recovery, or at least a partial recovery, on the consumer confidence report here in the U.S. that did come in weaker. Any new lows for the move in the 30-year bonds below a low that we have seen, or actually a series of lows over the last 4 or 5 days, I think should be viewed as a buying opportunity. So once new lows are made, I think that will probably be the lows for the move. Also keep in mind that at least 20 central banks since the beginning of this year have eased credit conditions. So how can the Fed raise rates with so many central banks elsewhere around the world becoming more accommodative? So longer term, still thinking the main trend is higher for the 30-year bonds, but I would like to see one more downdraft to come in on the long side. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.
You're all 780-868-75, so